It's very interesting looking at what's been going on in terms of merger mania, because in many senses, I think we've really reached a logical end for the time being. However, we do have a couple of massive deals pending. I mean, the New York Stock Exchange being bought by Intercontinental Exchange is really only a logical conclusion to what has been, unfortunately, a long-standing inability of the New York Exchange to really manage to work its way towards the future. At the same time, Intercontinental Exchange has demonstrated absolutely everything that a business should be, and it's a business that happens to run exchanges. Jeff Sprecher is very technological, he's very, very good at managing, he's extremely capable of not just bringing in excellent people to run his businesses, but also to upscale and indeed promote people who do that very, very well. Consequently, he's added a lot of value through a series of very, very good deals and reached the point where he himself can buy outright the New York Stock Exchange. It's going to be a very, very interesting course of time because I think there's going to be wholesale change within the New York Stock Exchange group. I personally am suggesting that Euronext will be sold off as an entire business. It won't actually go for an IPO. And at the same time, obviously, how the life business, the futures and options core of value within the European end of the NYSE empire is ultimately brought into the fold is going to be a fascinating piece of integration to watch. But I'm very optimistic because I think the one thing that ICE does is it creates fantastic optionality through markets. It adds a business that really sits at the top of the pyramid of the global department store exchanges that offer a multiplicity of different services front through back. But at the same time, it's also very much a great example of a business that has huge optionality and opportunity. Now, if we look at BATS and Direct Edge, I think that's a very different proposition altogether. What we see here is the amalgamation of two businesses whose core model, that of discounting and offering very, very cheap services to providers, has reached a logical end. We know that BATS in particular have been looking at multiple different ways to manage to add to that model, and obviously they had some problems because of their own IPO difficulties during the course of last year, which were driven by technology and of course a mega glitch which ultimately stopped the process. At the same time, Direct Edge has innovated very, very well, but it too needs some sort of a further momentum to move it forward. In that sense, BATS Direct Edge is going to be interesting, not so much in the fact that it suddenly leapfrogs NASDAQ, because that's like saying, well, Department Store A merged with Department Store C, and therefore it suddenly becomes bigger than Department Store B. It's really an academic calculation. However, how those two businesses come together and can then expand into, for example, a further deepening of the existing BATS options portfolio is going to be very interesting because this is, as I've long said, a derivatives world. At the same time, what's going to be very exciting is, can these companies come together and build an IPO franchise? Because the one thing that the US businesses of NYSE and NASDAQ have done incredibly well is create a country club model. Essentially, they have an exclusive franchise where you're brought into not a secret society, but a very public society in every sense of the word, where membership is exclusive. And therefore, it's difficult to see because obviously when you go to the golf club as CEO of whichever PLC it is and say, oh, well, I'm listed on NYSE or I'm listed on NASDAQ, that gives you a cachet. At the moment, BATS Direct Edge, BATS Edge, Direct BATS, whatever it's going to be called, however they market themselves, does not present the same cachet of exclusivity for a merged entity. And that's something that's going to be very difficult to compete with because where the NYSE and NASDAQ incumbents have done well is to essentially scale up the IPO advantages of offering as a unique process that adds to the brand of the company involved. I think the very interesting thing about Euronext is, I mean, there are lots of rumors that possibly even NASDAQ may go so far as to try and get rid of its OMX arm and actually look to bid. Those are, of course, completely unsubstantiated. But I'm not particularly sure that the buyer of Euronext is actually going to be another exchange group. Rather, I think there are lots of entities that have an interest in, say, private equity. I think there are also other people who would like to partner with that, for example, say, banks in France. We've heard a lot of discussion coming out out of Paris, where really the French government and French government agencies are extremely keen to see their market losing its transatlantic facade and becoming once again controlled by essentially French interests. I think there's also been rumours and discussions at different times that there may be groups who are looking to even buy out some of the components, such as the Brussels Stock Exchange, and recreate that. Because certainly there has been a major issue over the lifetime of Euronext so far, whereby some people feel that Brussels in particular has lost whatever investment banking edge it had locally to Amsterdam and Paris. So in the end, there are multiple potential bidders. We hear that, for example, the former Chi-X chief in Europe, Peter Randall, is extremely interested in leading some sort of consortia. He's been certainly trying to raise some money for some time. There are all possible bidders out there. I'm not convinced they are necessarily existing exchange groups. And in some ways, that might be even more worrying for exchanges, because let's face it, the titanic mega deal of the course of the last 5 years has undoubtedly been the NYSE takeover by Intercontinental. That's a business that didn't even exist 20 years ago, let alone was it a business that was run by an exchange insider. Rather, it's a complete upstart. And in fact, therefore, it is these new entrant or quasi-new, depending on your historical perspective, entrants that are adding so much value to the exchange market now. And legacy exchanges really have to be worried. When it comes to merger mania, I think it's also important to appreciate that I don't really think right now we are going to see a great deal more merger activity taking place at the top end. For one reason, some of the largest players have now really reached, in a certain sense, the limits to growth. I don't mean in the sense of the Schumpeterian and appalling book of the 1970s, which was quite wrong. Rather, what we're talking about is they've reached the limits at which regulators will allow them to grow. After all, last year, Deutsche Börse, New York Stock Exchange were not allowed to merge. Deutsche Börse have recently acknowledged in several cases that it's going to be difficult for them to actually acquire other exchange trading platforms. Their marketplace, if they look to acquire and grow through merger, may well be in buying other businesses, such as software services. If you look at NASDAQ, what they've done in the course of the last year, they've actually been acquiring either completely other asset classes areas, such as eSpeed from BGC Partners, which gives them access to the cash treasury bond trading market electronically. They've been acquiring all sorts of investor relations and other assets, which again help this whole department store feeling that that business has in terms of the exclusive listings franchise. Therefore, when we come to, say, the emerging marketplace, it's really very difficult to see what is the justification to any merger activity at the moment. None of the markets are sufficiently mature. Essentially, if we look at, for example, emerging Europe, you only really have two franchises which are in any way, shape and form coherent, cohesive, profitable, sound businesses. Moscow Exchange, fabulously progressive business, doing a great deal of good, very exciting, clearly backed very strongly, indirectly and directly by the Putin government. You've got Moscow as a financial centre coming on stream, $50 million a year of spend just to promote the financial centre, and that's going to give Moscow a great deal of impetus going forward. But is that marketplace really going to benefit from, say, acquiring some other small exchange in the region? It's very difficult to see. Likewise, we look at something like Warsaw. Well, the situation with Warsaw right now is that obviously the Polish market is very well developed, just in the same way that, say, the Romanian stock market is not particularly well developed. And it's obviously difficult to see any value for shareholders, let alone the market, in the long term between adding together different businesses just because they happen to share some degree of contiguity of border or some degree of interest in particular markets. Truly speaking, the whole of, say, emerging Europe, and indeed much of Asia, will be served much better by increasing competition, by much more excitement in the provision of services. And I actually think that what we're looking at there is you're going to see things like crowdfunding and alternative platforms coming through to challenge where stock markets have essentially failed within some emerging geographies.